Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Chris Sugden. He is the managing partner at Edison Partners. We're going to take a look at investing in FinTech startups and how coronavirus is impacting that. It's great to have you back with me as always.
Thanks,
Chris.
Jill.
And before we get into that impact, Edison Partners, you're known as a growth equity firm.
That's
investing in the FinTech space. Tell us about some of the companies you're looking to invest in, some of the key trends within the space.
Sure will. So yes, Edison Partners growth equity, and growth equity is this really wide expanse from late stage venture all the way to buyout. Everyone wants to be growth equity these days because there's theoretically less risk, more upside. Companies that are actually, for us, 10 to 30 million in revenue at time of investment. So in the FinTech space, we still are on a trend of rebundling, bring it all together from best of breed to rebundling. It's something we've been talking about for a couple of years now. A couple of interesting investments in our portfolio, a company called MoneyLion that's a neobank, if you will.
I've had them on my show.
Right, exactly. From open your bank account to open a wealth management capability, a robo-advisor, all in one. First time someone's been able to do that. Another deal in our portfolio, Yield Street, which we're really excited about. Lots of alternative investment platforms out there. This is a wealth management platform with alternatives as the theme. And there you have several sleeves to invest in: shipping, credit, litigation. So Yield Street's brought it all together, and you can open a wallet and get allocation to their investments. Long story short, those are consumer deals meets enterprise. On the other side of it, on the enterprise, we were just seeing before this corona crisis, if you will, the strategics start to get back in the market. What we were seeing was the financial buyers were all over the FinTech market. And as we saw with Plaid, we have a previously announced deal where our company in the capital markets trading space, Clearpool, announced with BMO a transaction. And we got one other under sort of NDA at this point, can't announce it, but strategics were coming back, realizing it was time to go invest in these startups in the FinTech space. And suddenly I'm wondering, we're only 2 weeks into this or 3, is this going to slow them down? Right now we're not seeing that, however. It's still moving at a pretty brisk pace.
Well, it's interesting. It's actually refreshing to hear you say that you're looking at companies that are already generating
There's
revenue.
a there.
Yeah, like if there's an actual business model and it's making money and it's not just a fabulous marketing story.
Exactly.
Big difference. We saw that in 2019.
Well, we're sort of facing, there was even before this last, again, few weeks of crisis, a bit of a reckoning. And I don't know if we want to go back to WeWork or other issues, but were we going to play all in for growth, or are we going to actually balance a growth and profitability story? I think this crisis has magnified it even more. But right now, I think the trade really is, would I be a 50% grower with either a real path to profitability or actual profitable business model, or do I want to be a 200% grower and hope the next round's around the corner? I think we're seeing more of the former than the latter. And just 6 months ago, it was all in on the latter, right? Give me hyper growth, grow at all costs mentality. That's changed pretty significantly.
And in a way, I'm on the side of the former because public investors, when they eventually get a piece of the deal, are always the ones left holding the bag, if you will. And in markets like this, where you need to have that strong cash, you need to be able to navigate these environments. I think it's a good thing that people are reevaluating how they're looking at deals, how they're looking to get into investments. So even with that said, with the coronavirus, do you think it's going to slow down the private markets, or people are going to stop being as entrepreneurial as they are?
Right. I think everyone in our business has their Monday meetings, and everyone's trying to figure this out, and
right.
has a perfect crystal ball. We look back at some data, so we've been around 35 years investing for that long. The last time we've seen anything like this was the Great Recession, right? 08, 9, 10. The last time we saw any real pullback like this in the public markets, it takes entrepreneurs a while to catch up. And so the way we saw it was, if this is a V-shaped kind of recovery or dip and recovery that's less than 3 quarters, you won't see the private market slow down, and you won't see valuations go down a whole lot, to be candid. If it gets outside 3 quarters, then you start to see the entrepreneurs realize, I've got to do something, and the market reality is the market reality. So I would tell you, if this is sort of a 6-month kind of episode, and we get beyond the election, and we're sort of back in a new normal, the private markets will not have slowed down, and you won't see a big, quote-unquote, correction in the markets. The companies that have to raise capital, so the venture, early stage, I'm out of money if I don't, that's a different story.
Right.
They're subject to the whims like this one of the market. It's the growth equity deals, the space we play in, and those above us in the ecosystem, they really face an issue where they'll just wait.
Well, that could be great for 2021 or towards the back half of the year.
Exactly
I mean,
right.
There's so much pent up demand.
That's exactly right.
That's out there.
Absolutely right. Absolutely right. I think what you're seeing is, again, no crystal ball. I try to read and talk to all the experts. You're going to see earnings pull back, right? Just flat out. So 2-3 quarters, again, you had the election kind of overhang anyway. So is this going to be a strange year as it was? Probably. We probably would have into Q3 before we saw anyone sort of say, let's wait. Now you're going to have everyone wait now. So the public markets are going to slow down clearly in terms of new listings. We've seen that. But again, I think the private markets, you may see things reprice a little bit, things take longer. I think the mega deals are the ones you have a bigger issue with in the private markets. Those slow down because those have to have the private, they have to have the public opportunity in front of them. So you'll see people take deep breaths. The bolt-ons, the acquisitions that are sort of add-ons to a platform, those will keep on cranking. We play a lot in the $300 million to $1 billion exit kind of market. That seems to be pretty darn robust. And as we know, the private markets are full of capital, right? We've had record fundraising year after record fundraising year. That creates an environment for exits to continue as well. Again, the platform deals, several billion to 20 billion, that market will start to slow down a bit.
All right, Chris, great to see you as always.
You too,
Thanks so
Jill.
much for joining us. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.